Hello, everyone. Welcome, welcome. My name is Emma Jordan. I'm a community organizer at Tech in Motion, and I'm so thrilled to welcome you all to today's webinar. For those of you who have been involved in this community for a while now, you know that 10 years ago, Tech in Motion was founded by staffing and recruiting firm Motion Recruitment, with a mission centered around bringing the tech community together to connect, learn, innovate, and discuss the hottest IT topics. Our community is constantly on the lookout for new event topics, passionate speakers, expert contributors, and more. So check out the link in the chat to explore more ways to get involved following today's conversation. Today, we are so excited to dive into an inspiring conversation with two exceptional startup CEOs who will share their valuable insights and takeaways into creating and scaling a successful tech startup. Don't forget to stay tuned immediately following the event today for a unique virtual networking experience. We will open up virtual networking once the event closes and provide an opportunity to meet with other like-minded startup founders, CEOs, and entrepreneurs. We have also invited this year's Best Tech Startup contenders from the 2024 Timmy Awards to join. So if you are curious to hear more wonderful stories about up-and-coming startups doing some truly amazing things like Indy, don't forget to stick around. Get to know your 2024 Timmy Awards finalists, and you can vote for your favorites now from now through August 15th at timmyawards.com. We'll put the link in the chat as well. So now, without further delay, I am so pleased to introduce to you our speakers today, Rachel Koretsky and Sebastian, to kick off and share more about themselves and get into this wonderful discussion. So welcome to the stage.
Thank you so much, Emma. Thank you so much for having us today.
Hey, everybody. Super nice to connect.
All right, so I'm going to be leading and guiding the conversation today. We appreciate each and every one of you who are joining in. If on the chat, if you want to introduce yourself, tell us where you're calling in from. If you have an idea and you're wanting to get started, if you're working at a startup, if you're building a startup, if you're scaling a company. So if you're able to share a little bit more and ask questions throughout, we're going to be taking questions in the chat throughout of this conversation. Well, first, I want to introduce myself. I'm Rachel Koretsky. I am the founder and CEO of Upace. We are a SaaS tech platform focused on the community rec center market, on how do you best engage and retain your clients. We support over 1 million members across 150 rec centers in the United States and Canada. And I'm also the founder and director of DC Startup Week, a community of 15,000 entrepreneurs, investors, and startup builders within the DMV, DC, Maryland, and Virginia ecosystem. And we have our large event, DC Startup Week, which is October 21st to the 25th. And I'll share a little bit more about that as we go on in this conversation. But I want to hand it off to Sebastian, if you could tell us a little bit about yourself and do a quick introduction.
All right, fantastic. Hi, everybody. Super nice to connect. Thank you very much, Rachel and Emma, for the intro. My name is Sebastian. I'm co-founder and CEO at weareindy.com, and we provide a back office CRM and workflow solutions for freelancers. So if you'd like to picture it, we are building the equivalent of what Shopify did for e-commerce platforms and small merchants, enabling lots of people to, let's say, quickly build and deploy online e-commerce, but for the service industry, for freelancers. So enabling the large community of over 60 million freelancers in the United States to easily run their service company online, with everything from how they represent themselves, lead collection, lead generation, client relationship management, contracts, payments, invoicing, time tracking, project management. So really helping freelancers who tend to have a really hard time to operate their business become great operators thanks to our services and products that we provide. So that's us at a glance. We have thousands of users on our platform to date and process a couple of million each month in terms of services between freelancers and their clients. And voila, that's us in a nutshell. And long term, we will be excited to help freelancers become successful in their work life and empowering them with great products and services that help them out.
I love that. And that's the best thing, is when you're building out technology that's solving problems and pain points that like your users need day in and day out. So tell us a little bit about how did you get started? How did you guys think about this idea? Tell us the story behind Indy.
Story behind Indy, way back when we started out of Venice Beach in Los Angeles, sunny Los Angeles, California. There was a small coffee shop near Venice Beach on Abbot Kinney. At the time, it was called Tom's Coffee Shop. And I used to go there to grab coffee with my co-founder. And we saw lots of people working on their laptops from the coffee shop. So eventually I approached some of these people and asked, oh, what are you doing? What are you working on? And that's kind of how we came across the freelancer. And in the early heydays of our company, we didn't have much funding. So we worked a lot with contingent workforce, and connecting to those people and seeing the space got me really excited. And then the core hypothesis was we are progressively moving towards a distributed and fragmented workforce. This is heavily enabled through technology. And as things evolve, what does this mean for the workforce? So we envisioned a world where people are going to be progressively working on an independent and distributed fashion. And with that, all the challenges that are going to come. What does that mean? How do I get income? How do I manage my clients? How do I be a successful professional? So that was kind of how we started out with Indy. So lack of funds, inspiration from local coffee shops, and basically envisioning a world where we are moving towards this distributed workforce.
So I love it. Like from going into the coffee shop, seeing all that, talking to people randomly. How did you continue to build your product? So you have this idea, you have this hypothesis, you started talking to people. Did you do a lot of informational interviews? Like what was the steps you took before you actually started to development, write the code, build out the user interface? What was that step between I have this idea, I know this is a problem, to before you started building?
So I think the first, if I would say, one is what I did when I started, and one is what I would do if I would recommend it today sometime along. So I will.
Let's see what you did and then what you would recommend. So we do 2 parts.
I think when we started out, we were very inspired by the space. We knew it was big. We did run like early stage. We would work with user testing, and we would interview people and show like prototypes and get just general feedback on the UI. And we did a lot of interviews. So we asked a lot of people, like, what are your biggest issues with freelancing? I think we interviewed maybe 300-400, maybe 500 people over a couple of months and weeks on a regular basis to understand what were really the big issues that they had. And we would go every day to this coffee shop, and that was kind of our collection pool of freelancers. And we also went to some local co-working places to really understand what is the freelancer challenged with. And I think that will get you to your first problem statement. You address your customer, you understand what their issue is. And then you have the second part of the problem is like, how do you start to actually design or work on a solution for that problem? And that brings in itself a whole other, let's say, can of worms, is how do you translate an abstract problem statement into a software solution or a product solution? And how do you ensure that that product solution that you're building is also, let's say, nice for the customer? So you have these 3 first initial steps that are not so easy to solve. And I would also highlight that sometimes you'll find the problem statement, you get the problem statement right, but the solution that you're providing to the problem statement doesn't stick. That happened to us. So the first product that we built for freelancers failed. We raised money with it and we launched it and we acquired users, but the execution was not working. So eventually we had to pivot and change the trajectory there. And even though we focused on the same problem statement, the execution that we did to solve it was radically different. And I think that that's something to be mindful of when you're building your company. You might be going after the right market, the right problem, but you might not get the product right on the first instance.
I think that's really helpful, because that was one of the things when I was starting Upace and growing was all about informational interviews. So what I learned early on was that the problem that I was solving wasn't the problem that the client was willing to pay for. It definitely was a problem, but it wasn't the one that was actually going to be one that could be a sustainable business model of. So by talking to hundreds of these professionals who would be the ideal client or the buyer of the product allowed us to build out the product to allow for it. So I love the story of, how it has to be both, right? By making sure you have the right problem by talking to hundreds of people who are your ideal users, ideal buyers, but also making sure that the product that you're going to build for them is the exact pain points that you're solving for them to be able to use it. So I know that you just mentioned as a part of that, you built that first product that didn't stick, but you had the funding that you put towards to build that product, as well as funding is a huge part about starting and scaling a company. So can you share a little bit about what were your first steps to securing funding? I know you've done, some significant raises over your journey of being an entrepreneur. So can you share a little bit about your funding journey with Indy and maybe some top advice that you would share as folks in this audience who might be thinking about fundraising?
I think your first round, when you have nothing yet, let's say you just have an idea and you want to figure something out, there's going to be two starting points. You either have some money yourself or you don't. You have some money yourself, you can bootstrap for a certain period of time, or you can work alongside, some other income source to let's say take an idea. Can also just be like some words, but you have to bolt that down into an analysis of the market and your ideas for the product, and you have to shape a first draft of how you're going to actually build this company, what it is, how it's going to work, and what your thoughts are, and where you would put the money, like really, because once you have it, you have to start to spend it. And if you have no clue how you're going to spend it, you're in bad shape because you don't really know what to do. So I think the time that you invest in understanding the core things that you want to try to do, it's very important. So let's say first money is going to be from yourself or from friends and family. If you don't have friends and family and you don't have yourself, you can try knocking on some angel doors. And I would say the first round is all about who you are. And essentially, it's a huge risk. So basically, you meet some person and they say hi, and they have this idea. They have some credentials, and whoever the investor is kind of sprinkling out money into the void to see if something happens. But I would say most angel investments probably, I don't have the numbers up front here, but will probably fail. And you're kind of sprinkling lots of small checks across different investments, anywhere between, I don't know, 10, 20 investments to stick the landing. I would say those are kind of your first sources. It's friends and family, yourself, and some angels. You have your resume and you have your track record that you can use, and it's all about is Rachel, is XYZ person trustworthy? Are they going to be ethical in how they spend my money? Are they going to be able to actually take this money and make something out of it and pass the first baseline? And I would say from that perspective, 50% is the pitch, 50% is the perception that people have of you, how you carry yourself, and how you present your business. And if at the end of the day you manage to emotionally compel someone to say, like, I'm going to invest in this really early stage because I think this is a great and really brilliant person, so let's go, and then they will give you some money. That would be the starting point, I would say, for your first round.
Could you share with us how much have you raised in totality throughout all of your startups, and how much have you raised for Indy? If you're comfortable, ballpark.
Sure. I'll give ballparks for the good and the bad. So I came to America with a friends and family round of $100,000 and a tourist visa, a few suitcases, and lived out of my uncle's living room in Palo Alto when we started out. When I left, it was $100K. It was super sweet, and it was enough. I think I paid myself $50,000 in the first year to kind of get by. Very low budget, and my friends and at the time I was working at Nestle. My manager said, like, you're nuts. That's no money. Like, what are you doing? And then we raised against the first kind of startup that I did around 10 million. Did not work out. And we the first company, I would say, execution was poor. We were able to acquire users. We had difficulties with it was hard. I can describe that in many ways, and I'm happy to dig into all the failures there transparently. Then we started our second company, and we raised money into the freelance premise. And I would say we raised also shy of 10. The second company eventually pivoted into what we are today. And today, into the current company, we raised 1.1 million into the existing product that we have. But now, and this is also from the failures I made in my first and second raises and challenges, it's working now, and I have a fundamental understanding of how all the mechanics are functioning and how we can start to, let's say, scale this business. So I would say without giving an exact number, that's kind of the two chunks. So around 10 million in the first, 10 into the second, and then we pivoted into the company that we are today.
So that's a lot of money fundraised over the years. And from talking to, I don't know, how many would say investors you have spoken to over the years of being able to raise around that 20 or so $million?
I think when you're raising money, it's like a funnel. So it's a sales funnel. You have a conversion rate. So you have a pool at the top, which is how many people are you reaching out to. You're going to do a combination of cold outreach and warm intros. You're going to have a success rate of those emails. Let's assume 5 to 10%, maybe 15, whatever the ranges, or open rate or response rate. The first thing you should send in your emails is send up front your deck. Again, different people will say, don't send the deck, send the deck. My experience is whenever you reach out cold, the first question, even if you get a warm intro, is send me your deck, because I want to see what you're talking about before I invest more time in you. So I would say you'll have a 5 to 15% conversion rate on the email to meeting. So for every 100 emails that you send, you might get 5 to 10 meetings. And that's just your first pitch. So that gives you a 20 to 30 minute, like, quick introduction, like, hey, I'm Seb, this is what we're building. You show the goods and what you're able to do and what you're thinking about. And then from there, I would say you have the next stage of the funnel is how successful are you able to go from that first meeting to let's spend more time discussing about your business or going into some degree of diligence. Let's assume, again, 10% success rate, 50%. It depends how good your pitch is. It depends how compelling the market. It depends on how well-groomed your audience was. So actually, I can add in an advice to that is the success rate of your pitching is directly connected to the quality of your materials, your oral communication skills, your charisma. Numbers, if you have them, are really important. Again, it depends if you're seed or what the stage is, and also who you're reaching out to. So, if you reach out to an investor who is heavily focused on medtech, and you're spending time with angels or with investors that have no knowledge or no experience in your field, chances are you'll have a lower closing rate, right? Or you might pitch them and I'm like, yeah, it's really interesting, but no, thank you. So I think they're also trying to filter out to some extent already upfront, to some degree. Like if you're in a SaaS space, focus on B2B SaaS investors. If you're in medtech, focus on medtech investors. I would say so. Screen for the type of investors that you're going after. Make sure that the investor is relevant with your industry. Understand that it is a sales funnel. So you're going to reach out to 100 people, and then you're kind of funneling down to your first pitch. You're funneling down into the diligence, and you're funneling down through the diligence across the different stages. In order for a deal to close, everything needs to line up. So that means they need to like you. They need to like the business. They need to like the industry. They need to understand. They need to like the numbers. They need to like your vision. So you need all of those things. It's really the gap between raising money and dating is not so big. It's really you want to find a match, and you want to vet through a series of meetings if it's a good fit. And that has to happen both ways, because if you bring the wrong person on your cap table and they're really like not understanding what you're doing and not understanding you, and you have difficulties to communicate with them when things are tough, or when you're going to have a setback, or you don't hit your goals, or even if you're hitting them, if you don't have, it's like a team member. So you don't want to be in a situation where every month or every time that you're meeting with your investors, you have attrition, because that's going to scare off all your future investors, because you want to build a team both on the inside of the company, but also around the outside of the company. You also want investors to get along with each other. So it's really about, I think as a CEO, you're on that intersect between your management team that's doing and working with you on the day-to-day business, and the outside team, which is essentially funding and supporting you to, let's say, grow it with capital. And those teams both need to be in a great place. So you want to make sure that you hire, I think, great investors. And that's really important.
I think that's so important you mentioned, like, just to reiterate that last sentence that you said, that you hire great investors, because so many founders go down this rabbit hole where you just want to find an investor. You're just chasing the money, you're chasing the cash, and not realizing it is dating. It is going both ways, where that investor has to be the right fit for your company, and you have to be the right fit like for the investor as well. And that way, like, some of the power is like some investors don't make sense for your business, and you have to say no at the right times, even though that's hard moments, because you are looking for the money. But like, as you just mentioned, like, if they're not the right fit for your company, they don't get what you're building, that it could just lead to more challenges down the road.
I would frame it on this basis. There are a series of key criteria that determine a successful relationship: compatibility, communications, values and beliefs, vision, right? And these are true whether they are for, a partnership, business partnership, or working partnership. And if you map those out, and then you look at each person that you're spending time with and getting to meet, you can understand also yourself, is this a good fit for me or not? And are we getting along? And do we have a similar premise? And will also happen, you might fall in love with an investor and say, like, that's the perfect investor for me, but they don't fall in love with you. So, well, you move forward and you try to find a way.
Exactly. Well, I want to pivot to, I know you touched a little bit about it around, challenges and failure stories and setbacks. We know like 99% of startups fail, so it's like that 1% of founders who do find success. And I would love for you to share a little bit about your previous startup that didn't end up working out. What were some of like the deeper insights to, maybe what you've learned from that experience that now that you've taken to Indy, from that failure that now has turned into a success?
So first of all, I would say nothing is a success ever until the very end. So I think you're always a little bit on your toes. And I think the moment that you say I'm successful or I've achieved a certain degree of success, you relax, which you don't want to relax. I would say second component to that is all the people, at least that I've met, who have a ultra net worth have all had at least one failure under their belt, or even a bankruptcy or other challenges. And I think that's a part of it. So if it's your first company, fight to win, but expect to get a potential knockout or black eye in the process. And it's really like getting in. It's really like getting into the boxing ring. You're gonna hit and you're gonna throw a few punches, but you'll get hit too, and you'll have your challenges, and you have to learn as you go along the way. In hindsight, I would say, so here are the first things I if I would have to do it all again, right? Your first focus is your deck. Very bluntly speaking, like, do you understand what the problem is that you're solving, the product that you want to build, how you're planning to sell it? Is the product that you're building truly in a market that it can grow big into and make a lot of money with? And who are the other players in the market, and how hard is it to get a piece of that pie, without spending too much money, right? Because if anyone can get massive market by raising massive amounts of capital, but I will say, especially in today's environment, investors don't want to see, like, we need tons of money to get this off the ground. There's always those, like, you see these like glamour cases, but there's so much money that's invested in so many deals that go by. So generally an investor wants to see like really efficient capital usage, low operating costs, low customer acquisition costs, great, like they want a lean machinery that's delivering results. So I would say, to enable your success, really understand your deck. And then I would say the next thing that's going to like kill you or not is you have your deck. Now you're building your first product iteration. Before you can get like a reasonable volume of people to really stick in the product and tell you, hey, this is a great product, and use it for a couple of months without leaving and are using it every day, you don't have a good product. Dot. And you have to look at that in a very fundamental way. If you bring 100 people in, and again, if you're enterprise, sure, you can get 1 or 2 clients. That's not the space that I'm in. We are we make an average of $10 per customer. So it's a large volume model. You bring 100 people in, How many of those people are in your product after 1 month, 2 months, 3 months, 4 months, 5 months after the first year? You want to stay super lean at the beginning so you can collect and build that data model and kind of get a feeling of like, hey, it's really sticky. People are liking my product. And I think until you haven't figured that out, that can take some time because you're constantly iterating your product, you're perfecting it, you're trying to get customers to stick. So, okay, great. You survived that now. You managed to finagle your product to a point where people are coming and using it and not leaving it, and you see daily or monthly engaged customers. So the next piece is pricing. So, all right, you got your customers through the door. Now they're using your product. You probably underpriced it at the beginning or made it super cheap because customers are really demanding at the moment. It's not the same market it was, 10 years ago where you can build like a crappy piece of software and people will use it. People have demands now. They're looking for good products. And if your product's bad, they just won't use it. So good. You did that. You built a good product. They're using it. Congratulations. Now give me money for it. Next challenge, right? You realize that you're taking money out of people's pockets every month and they're paying you for the service. Is your service good enough to get money for it? I think that's another, key breaking point. If it's free, it's one thing. If you're charging people 10, 15, 20 bucks a month, they're expecting a certain degree of service. Or if it's enterprise, like you're charging 12,000 a year or whatever the deal is. And again, there you're going to want to look at your churn. You're going to want to look at are they happy and are they staying on the system? How many people are subscribing annually? How many monthly? And what's the drop-off rate that you have month over month? And I would say the next and final piece that really has to click then is, so you got a product, they're using it, you're charging people for it, they're staying. And the next beast, which is really, really hard, is how much do you need to spend to get one customer through the door? And is the money that you're spending to get one customer through the door earned back fast enough for you to convince an investor to give you a lot of money to buy a lot of customers or to grow your customer base? And that's really difficult. So if you're enterprise, it's not easy because you need to say you don't have that many data points. So if you only have 10 customers and you got, I don't know, 1 million or 500K ARR, proving that you can repeat that up to 1,000 customers, it's not a given, right? And that you can really grow or scale. And if you have a small ticket price like 10 bucks a month, it's not easy, right, to advertise in a way that you're getting customers in or through the door for like $50. That means, you're going to Google. For every 50 bucks that you're spending on Google, you're getting one credit card, and that credit card is then sticking and giving you $50 back, and then 3 times more. It's not easy. And I think that is the second piece that takes time to optimize and perfect your funnel. And that's where some of your funding is going to go. And I would say that's really, it's a little Darwinistic. So you'll raise some capital. You're going to start spending on marketing. And if you're lucky, your marketing works sooner. And if you're unlucky, it takes longer for you to crack that puzzle piece of like, hey, we're charging 10 bucks. We're getting customers in for, 50. And after 5 months, we're making a profit and they're sticking with us for like 18 months and beyond. And we expect them to be with us for 3 years. Okay, great. Now it works. And on this premise, now you can start to raise money and you can start to invest more into buying more users. But I think those are kind of the first seed stage problem zones. So pre-seed, you have your basic product, and then the seed is about managing to get your customer acquisition cost and retention model down in a way that you can move to, eventually an A round where you can say, look, we have so many customers that proves our model. We can now grow this by, X percent year over year. And this is how big and it's a pretty predictable way how we can start to expand our business. Yeah.
I think that's really helpful going through like every single one of the stages. Definitely as you're talking through that growth of going from your first 10 customers to 100 to, 5,000 plus customers. There's different behind the scenes that you're working on at the same time, from marketing, from development, from product, through support. And one of the questions that we have in the chat, and it segues nicely, is could you share some insights into how you attracted, hired, and motivated individuals who helped bring your vision to life? And if you could start a little bit from when you just had the idea, like how did you bring people onto your team, to today that you have a product, you have users, and maybe how that might be evolved.
So just to make sure I got the question is, Rachel, how to get people to join you on your rickety roller coaster ride?
Exactly. How do you bring the team in? How do you bring in the right folks? Bring them into your vision? What did that look like for you?
So I'll share on two prongs there. Team is really important. If you're hiring really smart people, they'll only work for you if they feel that they can really flex and lead and contribute and participate. I think there are two drivers when you decide to join a startup. One is rational and one is emotional. The rational one is, if I forfeit a portion of my salary, because you're going to make a little less money to work for this person. Let's assume you say, in the first year, I'm going to give up $50,000 of money, dollars, whatever. Let's say they take a cut, $50K.
Yep.
So am I better off giving these $50K to Rachel because these $50K are going to convert to a fantastic investment down the road, or I'm better off of putting these $50K into a public market or another company and just keeping my corporate job or whatever the other job is that I'm working on? And that's a very rational decision, right? They will vet your startup and they will say, like, hey, especially I think if they're more seasoned, if you're going after someone who's, I don't know, in their mid 30s to mid 40s, they have experience, they will evaluate that investment from a cash perspective as well, and evaluate if that's making sense. So the first thing is you need to convince them. So the answer to that is convince them why the opportunity cost of their time and their money, because they're leaving money on the table to buy that equity that you're going to give them, is actually going to lead eventually to an exit, and is going to enable them to be successful. So that's the rational piece. I think then the emotional piece is, and that's a really important one as well, it is about the intellectual leadership challenge. You might have, a great person who's reasonably senior. They're looking for a leadership role. They're looking to really have this kind of adventurous experience, or to try something new, and to kind of maybe not have a boss who's telling them what to do and have more freedom. And so they are interested in that also from an emotional perspective. And I think if you can get those two to line up, then you have a good chance to hire a smart person who can come in. And I would say the third and final piece, and again, everyone has their own approach there, but I would say your first team members are like your co-fighters, and they really have to have your back. And I think you have to let them lead, and let them, segue and pave the ground in the areas where they're supposed to pave them, whether it's marketing or whether it's product development or design. And everyone has to know what their focus area is, because you're really small and you're really lean, and you want to make sure that you got all your ground covered across your different team members that are going to be in your company. And then the last point I will say is, when you co-found your business and you have your first co-founders, the hardest thing probably is, especially when you pick your co-founder, how do you know and how do you predict if the person that you're bringing in today is going to be as valuable as he is to you now, 2, 3, 5, 6 years down the road? And sometimes what happens is you start out, you hire your first person, and as the company goes by, either you or the other person, Darwinism kicks in, the company's maturing, but the team that's running the company is not growing fast enough and is making mistakes and can't keep up with the demands that the company has, and eventually is failing. And that's a really tough moment. So if you bring in a co-founder, you do 50-50 split or whatever, 2/3, 1/3, or whatever the way you split it. Like, what do you do if 1 or 2 years after that, you realize that, hey, I hired this amazing person, we're now raising capital and stuff is working out, but the person I brought on is like a great artisan, he's really great at building stuff, but the company now, we need to hire people, we need to do a lot of things. And the person that I brought in, who was perfect when I started my business, I gave this person 1/3 of my company, and now, I'm in the situation where the company's growing and his or her leadership skills are not growing fast enough for me to to like rely on that person. And then you have a really emotional, it's hard. Like, what do we do? How do we grow together? And those are also really important things to keep in mind, I think, is as you bring in your team, understand that in the romantic world, you want all of your team members to grow with you as the company grows. And in reality, that may or may not happen. And you may have to have some people now, and later you'll have to have other people. And that includes yourself. You're part of the same bucket, because you might be great to start the business, but it's not said that 3 years from now, as the challenges evolve, that your role will stay where it is. You might kind of rotate around in your company. And I would say the golden rule is always put your company first. So if your goal is to win, and winning means an exit or getting the company to be really successful, you can't be the weakest link in your company. So you need to make sure that if you're, as a CEO, not fit to lead, you have to step down, or you have to hire someone to do that job. And that's just very rational thinking, right? To understand, like, hey, I'm not good at this. The company needs this. It's going to take me a year to figure out how to do this. So what can I do here? How do I manage this? And how do I reposition myself in my company to make the company successful?
No, I think that was a really helpful answer about all the different journeys, from like your early days, finding that co-founder, to bringing on your first set of team members, and as you grow and scale. One question we have from the chat from Andrew, who asked, how did you find and vet good marketing people? What were the things that you looked out for with marketing and your marketing team?
Well, marketing's super hard. Marketing's super hard. I would say, if I'd have to say, for me, what makes great marketers today, in today's marketing environment, marketing is becoming increasingly, again, it depends on the business. I'm speaking from a freemium, large volume model with small check sizes, right? Quantitative skills are really, and I'll actually add this to another piece of that. Quantitative skills are really important. It is my fundamental belief that in order to lead long-term, you have to feel really comfortable with numbers. Eventually, your company grows to a point where you have to feel that you can see your company and see the world through numbers. And when we speak about marketing today, marketing is a numbers game. It is about a lot of data, a lot of measurement, a lot of modeling, a lot of attribution. There's creativity in it too. But from a leadership standpoint, it's about return on dollar invested in whatever XYZ marketing activity. And in my perspective, you need someone who is laser sharp on their quantitative skills to lead the marketing function. I think this is really important. So you want someone ideally who is on the intersect, or who is probably more quantitative oriented, but has a fundamental rational understanding that it needs to look great. The customer needs to feel great, and the empathic components, they understand they're key, and then they're bringing in the team members to cover, let's say, the representation and empathy dimension. But when it comes to the decision making, I think quantitative skills are absolutely essential. And if you are starting a company and you are coming from a more creative, art or design or background, I think it's important that you get used to working towards seeing your company and the world through numbers. And that will be that's another learning that I also had to make along the way.
And when you started, so you brought on some marketing folks, you started marketing your company. What were some of the first marketing initiatives that you did to really bring on like the first users of the platform? What was the first action steps?
I would say you have a bunch of different channels that you want to tap into. At the beginning, you can have your organic channels, whether this is your product hunts or your partnership deals. I mean, there's so many different channels that you can leverage on to start growing your customer base. I think you definitely, for me, there are two anchors that we let's say rely on. One is being able to acquire customers through digital marketing channels, also known as Google Ads. You understand what traffic you're buying, and you're buying this traffic and it's bringing qualified leads, and the cost of buying this traffic is profitable on the revenue that you make. I think that's really important because Google can scale, right? You can quickly deploy more capital into Google. A data point, one of our advisories was head of growth at a really large SaaS company, and they were deploying like, I think it was $12 million a year on Google alone in terms of their like ad spend. So it gives you an idea of on it was like a $42 million budget. So I think you definitely want to crack a couple of these scalable channels so that you can basically understand, hey, I'm spending this much every month. We're bringing in users. It's profitable. Dear investor, we would like to go from this spend to this spend. Here's 12, 18 months of data of how we spent this money. We want to do this at this scale. We have proof. Okay, clear. It makes sense, right? I can invest that money and it's going straight into the revenue. So that's for all the digital channels. So those you definitely want to start to pilot early on because they take time, and you will sink some funds into those channels until you figure them out, but they're really important. Another thing you want to keep an eye out for is once a user is acquired, are you getting an organic growth effect or not? So what's your referral rate? For every customer that you buy with hard cash, are you getting some surplus of users that are just coming through referral or on an organic basis? So we spoke about paid, we spoke about referral. Another huge source of both revenue and growth is partnerships, right? Depending on the company that you build and how your company's built and what the vision is, partnerships are great because you can share the CAC. So if you have two companies that are in the same vertical, but they're doing different products that aren't related to each other, but they're basically going after the same customer, then there's a great opportunity here to say like, hey, you cover this, I cover that. You go buy customers, I go buy customers. We share customers between each other. For each customer that I give you, we have a revenue sharing deal. For each customer that I get from you, we have a revenue sharing deal. So we both make revenue, let's say, with each other over time. I think those are great. And if you can have a couple of those, they will bring revenue into your company. So I don't know. Let's assume you're you're a company that makes fitness gear, whatever. A company that makes fitness gear, and you partner with a company that's specialized in physical therapy. And so basically you have a subscription of monthly, monthly clean gym shorts coming to your house. And you know that people in your customer base get injured through sports. So you partner with a PT company, and for each so when they sign up for their monthly subscription for the gym shorts, and alongside that, if for a couple of dollars more, they can get a monthly subscription to PT. But the truth is you're not providing that. That's coming from a third-party company. You're taking 30% cut, right? And then you can add in other types of revenue streams on top of that. That really helps because it can boost the amount of revenue that you're making from a single customer without having to build all the products to drive that revenue. And I think once you get your seed stage company to a place where you can partner with companies that are kind of in your range or slightly above, and then that's great, right? So you're obviously not going to partner today with, I don't know, Wells Fargo, because that's a huge company, but you can maybe partner with a smaller bank, or you can partner with a smaller PT company. So that's, and that also drives growth. So we spoke about partnership, digital ads, organic. SEO is another big one. For as long as Google's still alive on search, we'll see. It's really exciting what's happening. But I think that's another big one, is people need to be able to find you. So today, after this event, right, if you guys look up, I don't know, Indy Freelance or Indy App or just Indy, that you've built your SEO to a place where you're on the top 10 or top 5 or whatever the area, right, for your search. I think that's really important. You want customers to be able to find you, so that if there is word of mouth, if you have managed to build a product, that's great. People who are sharing like, oh my God, I tried this product. It's great for freelancers. I use it every day and it's a great price and I love it. Like, check it out. That if they type it into Google, that they're finding you. That's really important too. SEO is key. So those would kind of be the go-to platforms that you want to build out. By the time you're done with your seed and you're going into A round, those need to be in place. Otherwise, you can't run the A round. So your seed is going to be invested in building those core platforms. Like we have decent SEO. We know that we have organic growth. We know that we have locked in a few partnerships now, and we have a few more lined up. We are spending on ads, and this is our current ad budget. We could bring that up by at least 500% per month, XYZ. That's a good starting point.
And one of the things I want to add to that I love that you mentioned is like partnerships. Like for my company at Upace, partnerships have been golden for our growth. Like it's been, you build different areas of product, but you integrate together. The more that you can have integration points via API or ways that you work really closely with these partner companies, that's what the clients end game want. They want all your tech to talk the best that it can with one another, and building out good relationships with the partner and having your teams work closely together. So like their market teams and yours, their sales teams and yours, their support staff and your staff. So that way you're in tune step by step, that you're promoting the clients in the best way. That's been really critical to our growth at Upace, as well as like client referrals. And sometimes it's hard to ask like a client or a user to refer you to other clients. But if they're loving your platform and giving great feedback, like you want them talking on their internal channels or telling their friends or their peers or at events, talking about you and making that incentivized for them to be able to do that to help support your growth. And like one last thing to add. Yeah. And like your clients, especially when you're early, they want to support you. Like your early adopters are there like in your journey. So sometimes when you're sharing that with them, like my early clients in my company that were my first informational interview, that I came to them with a cold email, they said, yes, they'll talk to me. I gave them like the pitch of the product. I showed them the designs that I wireframed them out my early days. So it looks nothing like it today. But they were my first clients, and they were the first ones to refer me to other potential clients because they were like building alongside me, giving feedback, giving suggestions, and they wanted to see the success in the product get to the next level. And like use your clients to help you support your growth in that way from a marketing and sales perspective, and like have them be a part of your journey. And sometimes that's hard to share that, but they will love it.
I fully agree, Rachel. I think one thing you can add on to that, because I'm very numbers oriented, is if you say, look, for each customer that recommends me, I'll give them X% of the revenue of that person who's coming in, you're still getting a profitable acquisition, because let's say, as long as you're covering your costs of goods, right, your server costs or whatever, you're still making some profit. And if you have a good grip on your retention, once that first year goes by, right, it ramps up. So I think don't be scared to say, if you're a subscription business, hey, if you bring in a referral, X% of the revenue that we would make on our first year by using our product, we'll give that to you. And because your client's already paying you, they know the service, they're ideally retained, they're going to be happy to be like, hey, I'm paying for it, I love the product. If these other people like sign up, and I'm happy to share that revenue, right, during the first year. Can be half, can be 30%, can be right, whatever makes sense from your unit economics.
Exactly. And typically you'll see like that acquisition is so much less in terms of time spent, acquisition costs, and like your marketing efforts, because people forget like your time is also a big cost. Like finding them, writing the ads, where sometimes it's just an easier sales process with having that warm lead. If someone's like, I love the product, I've been using it for 2 years, you have to use it. And then those typically you get to yes so much faster, which that makes also a huge difference. Well, I want to pivot. There's some questions I want to get to within the chat. So one question that I was asked, for the pitch deck and financial model, there's some companies that have popped up that helps make it a little bit easier. They mentioned Ready for VC, who could help you do these things and get them in front of investors for a small fee. Is that more efficient when you are capital raising to put your information on a product that VCs are looking at?
Okay, just want to make sure I understood the question. So the question is, should I use is it a service to do the financial modeling for you?
It seems like, yeah, like it's a service, or it's a company that puts your your pitch deck out there where investors are able to review your pitch deck.
Oh, yeah. If anything that you can do to distribute your deck, public pitching events, online websites like, I don't know, Gust or whatever, like put it out there so people can see it. it's as we said in the beginning of the meeting, it's a funnel. So, for 1,000 impressions, you get XYZ emails written to you. For XYZ emails, you get XYZ pitches. For XYZ pitches, it's a funnel. So the more the top is big, the better it is for you, the more opportunity or probability chance you have of getting drops coming through the bottom. So any chance that you have to distribute your pitch, and same goes for your product, distribution's key. Distribute your product all over the place. The more channels you have, the better from a distribution standpoint. I would do the same also for your pitch deck. Get it out there, send it out. When it comes to building your model, again, this is my 2 cents to that. You, as a CEO, must understand your business model. If you don't understand and know all the intricacy of how your customers are coming through, how they're converting, why you're not losing them, why they're not connecting. If you don't understand that with meticulous detail and you don't understand your funnel, I would not invest. It's very important. You have to know your numbers the back of your hand. And if you're interviewed and the investor's asking us, so how's this? And where do customers convert here? And what's happening here? You have to understand your machinery. A business is like, I'm originally from Switzerland. I became American 6 months ago. So a business is it's like a clock, and all the little pieces have to clicker together. And you are the chief executive officer. So you have to understand how the machinery is working, and you have to understand all the master of design. You have to understand how these parts are working. So yes, you can work with someone to build your model, right? You're going to have a finance person to build that with you. But the architecture of the model and thinking in models is a absolutely necessary skill. Every time that you're about to validate a new investment, or every time that you're about to validate a new decision in your company, if you don't understand the impact of that decision, how much you're going to spend on it, how long is it going to take, how much % of people do you think are going to use that, how much money is that going to make on a per customer basis? If you launch this new feature, can you charge $2 more? How much are you truly uplifting your monthly revenue per customer? How much is it going to cost you? If you don't understand and think in those terms, decision making is very difficult. And so you have to do that to be able to make the right decisions if you're launching or taking initiatives in your company. And you're not going to make the next models down the road. You're going to have a team that's going to say like, oh, I want to do this, or I want to launch this, or I'm thinking about that. And the only way that you're going to have to evaluate whether this is a good decision or not, you have your intuition, this is clear, but you want to understand what's it going to do for the business. How much are we spending on this? When is it shipping? What are we expecting from it? How many customers do we think are going to, trigger from this? What are the success criteria? Those are really important things that you need to grasp, I think, as you make these decisions along the way. So my answer to the modeling software: yes, you can work with someone. Yes, you can work with an outsourced service provider. You can even do that with your deck. Absolutely. But if you don't know how to sell your business, aka you don't know how to do your deck, or if you don't know how your business model is working in a fundamental way, skin to skin, you're also developing a huge deficit. So I would be mindful of what portions of your understanding do you outsource to a third party. And if you do outsource the execution, you have to be very close to it, because otherwise the investor and your team and your employees will understand that you don't have a chokehold on your business, like a tight grip, but you're kind of just like, you have a vision, but you don't really have a grip on your numbers and your business.
100%. So I know we have just a couple minutes left. So tell us, what is a book that you're reading, or a book that you recommend, podcast, something that was helpful as you're growing and scaling, whether personally or professionally?
That's a great question. So, all right, I'll share a personal story to that. So in 2022, I spent 1 year paralyzed. I got very ill, so I needed to read a lot to spend the time. And I asked myself, what would I read about? And I started to read about, and it helped me a lot as a founder, to just understand how the stock market works, and to spend time in reading about how public markets function. It helped me because I think as founders, we are very passionate about building. We are creative, risk-taking creatures. But the people who give us money are less so. And if you go into the finance world, and I moved to New York 2 years ago, if you go into the finance world, it's beautiful. I mean, they make so much money, right? But they're sitting in the background and they're letting the operators like us like do the work, right? And they're basically funding across different pods to make the things work. But at the end of the day, as a founder, you are also, it's an ecosystem. So you have to work together with them to be able to build something big. So unless you understand how investment works, I think, and what are the drivers that are leading investors to make the decisions that they make and how they evaluate companies and appreciate them, it's a key skill there also to learn. I think as a CEO, you have two goals, right? Or maybe three. Make a company that delights customers and brings something good to the world. Hire or bring together amazing people that you're going to share that journey with. And the most important, create shareholder value. You are one of those shareholders. And so are the people that give you capital. So if you don't understand how shareholder value is created and how to generate valuation, then it's going to be hard for you to make a really big, successful company. And I think the best way to learn about that is looking at how companies are working in the public space. Why is the stock going up? Why is the stock going down? Why is this company more valuable than this other one, even though they have the same revenue? Like, look at it from that angle. And for me, that was a really useful exercise over the last couple of months. So books, reading, I would say, follow the stock market, look at how public markets work, be connected with the general business environment, and try to understand what is swaying company valuations to move up or move down, so that if you ever lead a company, that you understand what are the drivers that are going to make your company go up and down and what to look out for.
I love that, of understanding the stock market and how that works. What would you say if you had to go back to when you entered in your coffee shop where you saw all the freelancers working on their computer that day? What would you go back and tell yourself? Like, what would be that advice that you tell yourself on that day of seeing where you sit today, of, successfully at fundraise, getting thousands of users on your platform? What advice would you tell yourself?
Be financially oriented from day one. Understand operating costs, understand variable costs, understand the whole financial component of the business. I would say it would be that. And especially today, with the high interest rates that we have, it's very important. Access to capital is not the same that it was. The like money's everywhere, it's done. So today you need to have a really solid business. And I think that, like, let's go build, and there's a space in that now in AI. But even then, these are these like cycles, but even then, a successful business, it's the fundamentals are always still true. And I would say, if I would have to really start from day one, finance is a great background. It's a great background, and it allows you to look at your company in a pure, crystalline way. But then the downside of all people in finance is they just see the numbers. They don't understand, but there's actually like creativity and people that need to work to make those numbers happen. And that's where I think you have to be at the intersect as a founder. You need that creativity, left side thinking, that inspirational, like we could, crazy strategy, but you need to have also that kind of financial lens on it is very important. So having a good financial challenger by your side is also a great type of co-founder, by the way. If you're not financially oriented, if you're techie, get someone who's business oriented. If you're business oriented, offset, get a great designer, a great coder at the early stages. You need one like cash thinker. You need one coding guy. You need one customer design person to bring the dimensions together.
I love it. And my last question today, we have it from a chat from Ahmed. Operations or valuation? What's more important?
So I'll say this as well. Don't spend your whole day in your office. It's not good. If I'd have to put a ratio on it, I would say you should go out a couple of times a week. And I'm not, and not necessarily in like where there's a lot of founders. You should try to go spend time in environments that are foreign to you. One of the best things that I came across was spending time in alternative markets, private equity events here in New York. Phenomenal, right? It's a completely different world. And it's like X-rays of like companies. Like they just X-ray them as like in, out, interesting, not interesting. So yes, you should spend time out on the field. You should be meeting with investors from day one, understand what they're looking for, build empathy towards investors and funds. Don't spend and build relationships, because at the end of the day, it's also really about trust. An investor needs to feel that you're a trustworthy, like solid individual, and you're not going to be able to pull that off in the first 5 minutes or 30-minute pitch. Those investor relationships are built over time, and those funds, even angel funds or whatever, they will come because they've seen you around. They feel that if they give you a capital that this is going to pay out, and that you have your ethical compass in place. So ramble it out. I would say 70-30, 70% in office, 30% out. And later down the road, or maybe 80-20 at the beginning, or 70-30, and then later on you might do like half, something like that.
Yeah, that's what when I was thinking, when I saw that question come through, like both are just so important. So it's a hard question, but I think it's a great one to end on. I know we're hitting time at 3:00, and we're going to move to a networking component of this event where we're able to ask additional questions. I believe Emma's going to share a few words with that, but I want to say a huge thank you, Sebastian, for joining us today and letting me pick your brain on all things starting and scaling, failures, successes. I know successes are, always ongoing and ones to come, like at the end day, once the acquisition or IPO could be hit. But thank you so much for sharing your insights. We really appreciate it.
And we have I shot a promo code if anyone wants to try it out. We're a freemium product, but if there's any freelancers in the group today, we gave 30% off with Tech in Motion. Feel free to try it out.
Thank you both so much. Amazing. That was such a great practical conversation. I feel like I'm ready to go and start a startup now. You guys, that was so good. So yeah, that's our wrap on today's discussion. A recording of today's webinar will be sent out via email. So if anyone does want to revisit, I'm sure you all will, because there were so many great gems. You will receive that recording. Thank you to everyone who attended, and Rachel and Sebastian, again, thank you for sharing your experience and knowledge on such an important topic.
Everybody.
I'm going to go ahead and open up the virtual networking room in just a minute. So please join us there to keep the conversation going. You can get more of your questions answered as well. There were quite a few we didn't get to. So everyone hop over there. You'll get a little notification on your screen. Also, be sure to follow us on social media so you can be the first to know about the exciting events we have coming up all throughout the rest of the year, and so you can stay tuned for the announcement of our Timmy Awards winners. All right, I'm going to kick off virtual networking, and I'll see you all over there.